So this video is a follow-up from the previous video on price floors, and it's still looking at Scotland and their decision to implement a minimum price on alcohol. Now, just to remind you, the reason that we're doing that was to tackle the negative externalities associated with this demerit good. They believe that alcohol was being overconsumed, especially by problem drinkers, and that was causing a strain on the NHS and the police service. So the focus of the video is still going to be Frosty Jacks, because if you remember again from the last video, that had the biggest price increase of all the alcoholic beverages that were targeted by the government. We're going to have a closer look at the diagrams, and we're going to see how we could use the diagrams within our analysis or our evaluation. So to begin with, what we're going to do is we're going to look at the consumer and producer surplus. So let's imagine at this point here of P1 and Q1, there has been no price control. All right, that's just allowing the free market. Okay, now the consumer surplus, okay, and that's their ability and willingness to buy the product at any given price up until that market equilibrium. So that's the market clearing price. And then we've got the producer surplus, again, the producer's ability and willingness to produce at any of these prices leading up to that, again, market clearing price of the market equilibrium. Now, what we can do is we can now implement the price floor. And what we've got is I suppose it's been sectioned with different letters. So just to kind of bring back to the original market equilibrium, we had a consumer surplus of A, B and D. All right, that was the original consumer surplus. And the original producer surplus was C and E. Okay, because remember that's the market equilibrium of P1 and Q1. Now, the government have brought in the price floor, and because they brought in the price floor, what we've got is demand has contracted to Q2. So we're going to focus on Q2 of this because that's where the demand is. And what we're going to look at again is the consumer surplus. Now, the consumer surplus was A, B and D, but now it is simply A. So consumer surplus has fallen. And I suppose that is pretty much what the government was hoping for. Now, if we're looking at the producer surplus, it was C and E. But now, because of the price going above the market equilibrium price, what they've got is they've pretty much adopted B. So what they've got is C and B, but they have lost E. So when we have a look at the total welfare, we have got previously it was pretty much A, B, C, D and E. But now what we've got is we've got A, we've got B and we've got C as the total welfare. So the welfare that has been lost because of that, and again this could be an argument as to the inefficiency of this pricing strategy and this price control, we have lost D and E. Now, what we're going to delve into next is we're going to look at the price elasticity of, again, Frosty Jacks. So, as I mentioned at the beginning of the video, it did see the biggest price increase. It went from £3.99 to £11.25, which is significant, okay? In fact, it's a price change of 182%. So there's been a 182% increase. Now, doing a little bit of research and having a look at the change in the quantity demanded, a newspaper article suggested that sales had been hit by 70%. So what we've got is the price has gone up by 182% and the sales have fallen by 70%. So when we're having a look at this diagram that we said before, yes, we've said that demand has contracted, but what we need to look at is actually how responsive was the contraction in the quantity demanded. And that diagram doesn't really show it, because if we did the formula of price elasticity of demand, what we'd get is minus 0.38, which shows that actually it's inelastic. And therefore we could, and this isn't to scale, but we could roughly say it's something along the lines of this. All right. So we can see the percentage change in the price is obviously much greater than the percentage change in the quantity demanded. And therefore, even though demand has contracted, it hasn't been that responsive. Now that could be because, again, possibly those on a higher income, it's still not really impacting them. Maybe those on a low income, possibly they didn't really buy it anyway, or they bought it not that frequently, and therefore they've decided, okay, I'll still buy it when I want it. Because it's less frequent, it's not going to put me off. Or maybe you got those problem drinkers who, again, they've just decided to continue to buy it, and that might be a sacrifice of another product, and that it does create an opportunity cost for those problem drinkers. Some have decided to move away from, obviously, Frosty Jacks, but what you have to think about there is, well, where have they gone to in terms of, have they quit drinking? Have they completely given up? Is that realistic? If they're a problem drinker and possibly addicted, then you could argue that they might not be able to just quit just like that. But if the price has caused a problem with such an increase in the price, then what we might get is, yes, they might contract, the demand might contract slightly, but then what they might be doing is they might be moving to other goods. And therefore, we can start to look at maybe cross-price elasticity of demand. Now, I haven't got any figures here, not necessarily in terms of calculating cross-price elasticity of demand, but what I did see was an article which suggested that other products actually saw their demand increase even though there was a price control that was implemented. So fortified wines, for example, they saw a very, very small increase, or they might not have even seen an increase at all. But in some cases, it was tiny. So what we could look at is, well, if we're seeing a contraction of demand for Frosty Jacks from Q1 to Q2, then what we might see is we might see an actual increase in demand. And what we can do, so for example, that there will be a slight contraction to begin with of, for example, Buckfast going from Q1 to Q2, but then all of a sudden, all those customers from Frosty Jacks that we've just seen leaving that market, they will now come to this market and we'll see a shift of D1 to D2. And what we'll see now is actually an increase from Q2 to Q3. Now, the question is that a problem? Is that an issue? Because they're still drinking alcohol and they still might be drinking it in an excessive amount because, again, it's trying to target problem drinkers. And I suppose what the whole idea of some of these drinks and how they've been targeted, it has been targeted based on volume strength. And the fact that some fortified wines have not had as big of an increase in the change in price as, for example, Frosty Jacks, suggests that actually, even though they are still drinking alcohol, it might be more of a positive change because of the lower volume strength. You have to remember, with a bottle of Frosty Jacks, you're pretty much in one bottle drinking a week's worth of recommended units. And if you're a problem drinker, you might be drinking more than one a day. You might be drinking, again, every single day. So it could help the situation, but it's still not going to obviously prevent the drinking of alcohol.